And we think that we are in the early stages of a productivity boom. Technology-led productivity gains are kind of like fairy dust. They make everything better. They make real growth better, higher. They make inflation lower. They boost real wages. The Roaring 2020s idea is still one that we're promoting. It's our base case.
Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Jack Forehand is a principal at Validia Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validia Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validia Capital.
Hey guys, this is Justin. In this episode of Excess Returns, Jack and I sit down with Ed Yardeni, president of Yardeni Research and YardeniQuickTakes.com. Ed needs no introduction, as he's been one of the most accurate Wall Street strategists out there. We cover as many topics as we could fit into an hour, including his outlook for inflation in the economy, why he thinks the market could be in for a roaring 20s-like period, and why he believes we might get fewer Fed cuts than many think. We also discuss the characteristics of a good forecaster, the impact of AI on the economy, the election, and a lot more. While many forecasters can get locked into their opinions, Ed's flexibility and data-driven approach have allowed him to build one of the best track records on Wall Street, and the reasons why shine through in this interview. As always, thank you for listening. Please enjoy this discussion with Ed Yardeni. Hi, Ed. Thank you very much for joining us today.
My pleasure.
We're excited to have you on to talk the economy, the markets, and help us sort of separate what is noise out there from real signals when it comes to sort of the economic growth and trajectory of things and the markets. So this is going to be a fun conversation. And you know, you've been doing this for your entire career. So one of the things we definitely want to talk about too is sort of your views on forecasting and what makes for a successful forecaster, and when someone's opinion, you know, based on the data should change, and sort of how you sort of view those things. But I thought to start, we could, and I was listening to the Barry Ritholtz Masters in Business interview, and you were talking about when you were at Yale in Tobin's class, and how you sort of owe a thank you to Janet Yellen and helping you understand some of that material. So I thought we could just start there with a fun little story.
Yeah, well, it is a fun story. I graduated from Yale 6 years after Janet Yellen, so she was there before I was, and she attended the same PhD economics program as I did. She studied under James Tobin, who was a Nobel laureate, a very famous macroeconomist. And I don't know where she sat in the classroom, but I have a hunch is right in front. And she took copious notes and had charts in there she must have brought a ruler to the class. Anyways, that was kind of viewed as the unofficial textbook of the macroeconomic text, the macroeconomic course that Tobin taught. And what she was kind enough to do, apparently, is people Xeroxed those notes. And 6 years later, I was reading from those notes. So I owe her a lot, because Tobin was pretty hard to understand, but she made it a lot easier with her great notes. So thank you, Janet Yellen.
That's awesome. That's a great story. You know, I'm looking at you here, and I've always seen this backdrop of books you have in back of you, and I think it's either between you and Michael Mauboussin are the two guys with like the biggest libraries I think that we've ever had on, which is amazing.
Yeah, but that's so yesterday, you know. I don't buy books anymore. It's all audio.
Yeah, no, that's true. But
by the way, I have to say this. I'm reading Elon Musk. I'm listening to Elon Musk on Audible, and it's really worthwhile just to see the guy's a genius, that's for sure.
I'm just curious. Do you listen to podcasts?
Yeah, occasionally.
Yeah, I think that is. It seems like more and more people are as we move forward here.
But I think the book comment is kind of a nice sort of way to work into the next question, which is, you know, a lot's probably changed for you over the years in terms of the tools and the resources that you use, and you're looking at day to day, and you're trying to interpret what's going on in the economy. So if you were to just kind of at a high level outline, like what's changed over the last 20 to 30 years with the way that your work is done, how would you capture that?
Well, the first thing that comes to mind is when I first started out at E.F. Hutton in the late 1970s, when we wanted to do charts, we had to print out the data on paper and then bring in a draftsman and give the draftsman sort of a sketch of what we wanted to have the chart look like. And then the draftsman was actually take tape and put it on a draft board to create this chart, and would put in the labels and all that. So it was extremely time consuming. And then once it was done, we'd have to hand deliver it to the printer, who then took photos of it and then somehow or other transferred that into the publication. So it was like a ridiculously painstaking process, and you couldn't really do too many charts. What's changed for us is several years ago, we designed our own in-house charting system that automatically updates the charts when the data is available. And recently, we've converted that to LSC data stream, and that platform allows us to do the exact same thing. So instead of having to grind out these charts manually with the help of a draftsman and a printer, now they're automatically on our website, which means, for example, when the employment report comes out the first Friday of every month, the data is instantly included in the charts. And so I don't really have to wait around very long to kind of get a lay of the land of how things look. So it's really phenomenal.
And by the way, most of those charts are like in front of they're not behind a paywall, right? They're not blocked. So I often find myself like Googling like, S&P PE, historical PE, and I find myself on, on one of your PDFs or something.
It's all open to the public, and
that's nice.
That's by design. I guess as a capitalist, I kind of hope that people like the charts and how we convey information, and then kind of makes them want to see what's behind the paywall for our other research. But yeah, it's like credit. It's open to the public. What's different is you can't manipulate it, but it's available instantly, and there's thousands of these charts that we create.
Yeah, it's very cool. Just one last question before we get into some of the economic stuff with you. Do you think that, so Yardeni Research you've been an independent research firm for over 17 years, so almost 20 years you've effectively been. Do you think that in some way, I'm going to use the word edge, it's probably not the right word, but because you're like independent, you can think maybe more freely and maybe more accurately than others? I mean, this isn't like so much like throw other Wall Street strategists that work at these big banks under the bus or anything. I'm just wondering, that level of independence, do you think that's an advantage in some way?
Well, I'm biased to tell you yes right away.
Of course.
I'm better than the big guys. And by the way, very often we seem to have the same forecast as Goldman, and more often than not, we come out ahead of them. So we're kind of like-minded with some of our Wall Street brethren. But I think that being independent is great. I mean, we don't have any lawyers that have to do compliance and check what we do. Of course, we don't recommend individual stocks, which obviously helps, but we don't have a bunch of administrators overlooking what we do. And as soon as we want to write it, and we put it down and send it out. I put out this quick takes every day, and I just sit down, write it out, and as soon as we edit it and it reads right to me, we send it. So I think we have a pretty quick turnaround in our ability to respond to the market. But I think and being independent helps because it actually also makes you more insecure. Adam Smith said that capitalism is all about selfishness. And as an entrepreneur, I think Adam Smith completely blew it. What a terrible way to sell capitalism. It's not selfishness, it's insecurity. I'm insecure because I got some amazing competitors. Ed Hyman's one of my competitors, strategists, Jason Trennert, Nancy Lazar. They all used to work together, but they're fierce competitors. Wall Street is a competitor. So I have to provide some really good research in order to compete.
I want to ask you about the economic landscape at a high level, at least for someone like me who hasn't seen this before. What we've been through is obviously been very interesting. I mean, we had COVID, we had high inflation, it's come back down. Can you just talk about where you think we are right now?
I think we're normalizing. There's been a lot of controversy since 2022 about whether the tightening of monetary policy in response to the surge in inflation, uh, uh, what the consequences of that would be. And the widespread perception in 2022 and 2023 was that we would clearly, obviously, have to fall into recession. And that was in our position. That we thought the economy would prove to be resilient for a number of reasons. And here we are again in 2024. We're getting near the end of it. But throughout this year, there's been still lingering concerns about a recession and perception that the Fed has to get on with lowering interest rates rapidly or we'll fall into recession. Our view has been that the Fed, yes, sure, they tightened interest rates, they tightened monetary policy in 2022 and 2023, but they also normalized. I mean, they raised it from 0 to 5.25%. Everybody said, well, they raised it 525 basis points. They raised it from 0. And if you look at the charts, 4 to 5% is kind of where interest rates were in the good old days, the normal days. And I'm talking about before the great financial crisis. So I think we're just normalizing, which is worked pretty well in terms of thinking about the markets. And everybody, when an indicator comes out and it looks on the weak side, everybody jumps on it and says, there's the recession. Now we say, well, hold on, let's look at this a little bit more closely. We did that with the past two employment numbers and came to the conclusion that, this is not going to set us up for a recession. And the Fed's going to ease, but we think that they got to take it easy in terms of how quickly they ease, because in the past they had to ease to avert a recession that was caused by a credit crisis. And our thesis is that this time around there has been no credit crisis because the Fed is much more adroit at playing whack-a-mole in the financial markets. When something blows up, they create a liquidity facility. So I think that has to be taken into consideration, into account in explaining a lot of this monetary policy cycle and business cycle.
Can you talk a little bit more about what you saw? Because we've had probably two different types of economists on the podcast. Some people who thought inflation just was not going to come down, and other people who said, you raise rate that much, a recession is inevitable, it's coming. Yeah. And you were kind of down the middle on that. So what did you see that a lot of these other people maybe didn't?
Yeah, well, in the summer of 2022, when inflation, in fact, was peaking, we said it's peaking. And we put out a chart showing what we thought it would do over the next couple of years. And, I've had some good forecasts and some bad forecasts, and this one's been right on the money. It came down, and we wrote that we thought that the durable goods inflation rate in the CPI and the consumption deflator, it's durable goods, it's non-durable goods and services are the three major components of the inflation indicators. And we kind of went one by one and said the durable goods order inflation rate is clearly largely related to two phenomena. The supply has been challenged because of the ports not being able to process all the deliveries from overseas. And the reason there was the ports were congested is because following the lockdowns, we all had cabin fever. And when you have cabin fever in America, you tend to go shopping. It makes you feel good. It makes us all feel good. It releases dopamine. And so we all went shopping, but we couldn't buy services. There were still social restrictions in services. So everybody bought goods. My wife went out in May of 2022 and bought a garden set so we could eat outside instead of inside now that the spring was coming. And the salesperson said, you know what? This was early May. Salesperson said, this is the last unit we have. We just ordered a whole bunch more from China. And so it kind of, I looked for the anecdotes like that. And so, what if everybody else is doing that? And sure enough, it was a kind of a short-term buying binge combined with a supply problem that we thought would be ameliorated over time. The binges don't last that long. And so the durable goods inflation rate has come down and it's now actually negative again. And historically, at least, for 10 years prior to the great virus crisis, uh, durable goods prices were down. Non-durables, we said, hey, look, food and energy, which are the main components there, they're commodities. And there's a lot of people freaking out about the soaring oil prices and food prices in 2022 when Russia invaded Ukraine. But we just came up with the old adage, the best cure for high commodity prices is high commodity prices. We thought the prices would cure the problem, and they did. And now we're looking at oil prices taking a dive here, actually. And then on the services side, we said, most of that is the service. On the services side, rented it gets the biggest weight. And we thought that there were a lot of pandemic-related pressures on rent that would dissipate, and then we'd see an increase in multifamily housing construction, which is what happened. So it all came together really quite nicely for us, and we just kind of put it together that way.
Do you see any kind of near-term risk of a recession? I mean, we had seen some softening in the data, but
Yeah.
it doesn't seem like it's on the near-term horizon. But what do you think about that?
Yeah, I don't think it's on a near-term horizon. I'm I'm trying to stay open-minded about it because we have been sort of on this roll. Speaking of rolls, I have been telling everybody that since 2022 that we're in a recession. It's just a rolling recession hitting different industries at different times, particularly the interest rate sensitive areas. And it basically was housing and commercial real estate. Auto sales haven't gone straight up, but they haven't gone straight down. They've been holding up remarkably well in the face of higher higher interest rates, auto loan rates. Mortgage rates are coming down now sharply with the bond yield. So that means that the rolling recession in housing should be coming to an end, and we should see some improvement there. But the key is clearly the consumer. And it's been our observation that you can't generalize about the consumer. People try to say, oh, the delinquency rate's going up. The consumer's about to is going to be forced to retrench. There's a lot of consumers with different kind of experiences, and maybe my inside information, my edge, in understanding the consumer is I'm one of them, and then my wife is one of them, and then I got 5 kids, so I kind of know what kind of younger people are buying, and then my youngest of them all is a world-class shopper, so I kind of watch what she's doing, what her friends are doing. But I also saw what my friends were doing. A lot of them are retiring. The baby boomers are retiring, and they're retiring. I said, well, I was kind of curious. I mean, how much do they have in retirement asset? And the answer is $75 trillion, not billion, $1 trillion is what the baby boomers have. So basically 75 million baby boomers have $75 trillion in net worth. And now they're retiring. And when you retire, guess what? You don't save because you don't have income anymore. Maybe you have interest income and dividend income, but you don't have earned income. And now you start to dip into that nest egg. Either you live on interest and dividends if you were lucky enough so that they're substantial. Otherwise, you start to spend that money. And especially coming out of the pandemic, a lot of people had some time to think about the meaning of life. And I guess a lot of my friends thought the meaning of life is to retire and travel and eat out and just have a grand time. The baby boomers, most of them don't really have mortgages anymore, and they're not paying for colleges anymore. So they're kind of as free as birds, and they're spending money like mad. And then that gets to the other issue. You see these surveys where they interview people and say, does your paycheck last to the end of the month? And you see a fair amount of people saying that I don't make it to the end of the month. And some of them are probably young people, and one of them is one or two of them are probably my younger kids, and they probably will say, my paycheck doesn't get to the end of the month, but my dad pays my credit card. So I think there's a lot of that going on. A lot of baby boomers' kids, the younger ones, anyways, are still living at home. I guess it's and they're getting rent free. And so when you look at it all together, I concluded that, you really had to see consumers losing jobs. And we just don't see that currently happening.
You talked about you're keeping your eye open for the potential signs of recession. Are there any most important indicators you follow or anything you look at most closely when you're trying to analyze that?
Well, I think at this point in the business cycle, clearly everybody, including ourselves, is looking at the labor market. The capital spending looks quite strong because a lot of it now is technology, and a lot of people rent software, for example. So if interest rates go up, and you're a company and you spend a lot of money in software, it's not like you're buying a package of these things. You're renting it. So capital spending hasn't really been very interest rate sensitive. So it really gets us back to the consumer, and that in turn, I think, really focuses us on the employment indicators, which is why the markets are so sensitive to the employment indicators. But in the past, in the latest month, and so we're talking about the data for August that came out a couple of weeks ago. We looked at the data and said, yeah, it looks weak when you look at non-farm payroll employment up 140,000 or so during the month, and there were downward revisions the previous month. But what about the average work week? And the average work week actually rose quite nicely in August. And so when you look at aggregate hours worked, total hours worked, it actually rose to an all-time record high in August. It's one of the reasons that the Atlanta Fed's GDP tracking model actually revised upwards the outlook for GDP after the so-called weak employment number. And then we go further than that and say, okay, that looks pretty good. Now, how about the impact on wages and salaries? So there's something called average hourly earnings, which is wages in the employment report, and said, okay, let's see what this looks like in terms of hours worked and the wages received. And that too is at an all-time record high. And it actually rose quite sharply in August. So we're expecting a pretty strong retail sales report. Now, industrial production, there's hours worked in manufacturing, and that looked kind of middling. It's been kind of weak, flat to weak of late. But we noted that in July, there was a big drop in auto production that probably had a lot to do with this screwed up seasonal adjustment factor. And so we think that we could have a couple of numbers here that suddenly make everybody like head turn and say, well, wait a second, maybe there isn't a recession out there, and maybe the economy is going to continue to perform well. So, it's a hand-to-hand warfare in this business. We go kind of indicator to indicator. We have our views of what they're going to do. And then when they come in, if they come in supporting our story, they're good numbers. If they come in questioning our story, then of course they're bad numbers and they're going to be revised.
To your point of the employment report, I've always found it interesting as someone who's outside of this. Like, I probably before 2021 had never cared about a CPI report in my whole life.
Yeah.
And then that was the absolute center of everything. And now
Right.
it seems like just recently we've had this shift. Like the inflation report doesn't matter anymore. Now the employment report matters.
Correct.
It's interesting to see those as someone who's like outside of the space.
Well, it's all because of the Fed. I think one of the things we do pretty well is Fed watching. As a matter of fact, a couple of years ago, I wrote a book called Fed Watching for Fun and Profit. And so I went back to Paul Volcker. Actually, I went back even earlier than that, just to get a sense of what drives the Fed. And the focus is very much on the chairs of the Fed, because they clearly influence and control the message coming out of the Fed. So on August 23rd, I believe it was, in Jackson Hole, Wyoming, we have that famous annual conference that the monetary policy makers get together, and everybody looks forward to the speech by the Fed chair. And sure enough, it was a consequential speech given by Fed Chair Jerome Powell, in which he said that, you know what, he didn't say mission accomplished. He came pretty close to that, saying, we're pretty confident we're going to get to 2% on the inflation rate. We're not quite there, but we're kind of close enough. And so instead of the balance, they have this dual mandate of unemployment and inflation. So instead of being kind of biased towards worrying about inflation being too high, we're not kind of switching to being more concerned about the unemployment rate going up. And so everybody said, okay, the rules have just changed. So let's put a big focus on the employment numbers more so than the CPI. Of course, that sets us up for some surprises to the upside in inflation, and suddenly everybody will change the rules again. but that's what's fun about this business.
Sort of on the fly here. Like if you were to think back to the last, 5 Fed governors, or chairman, Volcker, Greenspan, Bernanke, Yellen, and Powell. Just, is there any, well, let me ask about Bernanke. Like my view is he was a great chairman during the financial crisis. And so that was the guy we needed sort of to lead the Fed during that period. But, just in general, do you think that these Fed chairmen have done, you could pick any one or maybe just the last 3, Powell, Yellen, and Bernanke, like how, in your view, have they done in terms of leading the Fed?
Well, I think Yellen, we started out talking about Yellen. I think Yellen did a reasonable job of running monetary policy. She was kind of low key about it. I think the problem I had with Greenspan and Yellen is that they they had this obsession with avoiding deflation, and so they kept interest rates way too low. They're basically at zero, and so I think you're giving Greenspan some credit, but I think he made some pretty significant mistakes in not raising interest rates more, going into the housing bubble and fueling the housing bubble. Bernanke had this also this concern about deflation. So we had 3 Fed chairs that gave way too much weight to the risk of deflation and kept interest rates too low. And then the whole process of quantitative easing, where they actually meddled in the markets. It's one thing to meddle in the Fed funds rate market, the short-term interest rate market, but they really had no business going in and buying bonds. But that's what they did. The ECB did it. Other central banks did it. So we had this great abnormal environment where interest rates were near zero, and there's so-called quantitative easing. I think all in all of the ones that you mentioned, I'd say Powell probably did probably the best job of them all. I know he gets criticism for being late on raising interest rates to hold off inflation in 2022. He'll never admit it, but I think part of it was that his chairmanship, his term as chairman was coming up, and he wanted to get reappointed, and so he went totally woke and said all he really cared about was keeping the unemployment rate down, which at the time, was legitimate because it was 2020, 2021, 22 early on. He could argue that the labor market was still having issues, but the labor market tightened up real quickly, and he did make an adjustment quite quickly and made a very credible stance on bringing inflation down. And so far, so good. I mean, it has come down, and I think he'll get credit, though I think the economy deserves credit more than he does. But he'll get credit for having managed to fly the plane and land it in a soft way, a soft landing. In other words, I call it immaculate disinflation. The idea that inflation, I always thought inflation could come down without a recession. And Powell, every now and then, said that that's what they were aiming to do. And I think they got it. And it wasn't all because of what the Fed did. There were other things going on in the economy that made that happen.
It's funny. We did an episode with Meb Faber where we talked about things that he believes that most investors disagree with. And the thing we got the most pushback on was he thought the current Fed had actually done a pretty good job. But if you survey investors, I would have to think like 95% of investors always think the Fed's doing a bad job.
Yeah, I always consider the contrary case. I don't take a contrary viewpoint just to be different, because you can certainly get some notoriety that way, and then you get a lot of notoriety when you're just dead wrong. But I do kind of try to say, well, what does the crowd believe, and what might they be missing? And by the way, I think that's one of the reasons that I'm often labeled as a perma bull, is because the perma bears do such a wonderful, great job all the time of telling us everything that could possibly go wrong. They make life very easy for me. I don't have to do a lot of work to figure out how things are going to blow up. But then what I do is I say, okay, now what's wrong with that picture? What's wrong with that story? And more often than not, I come up with a story that I believe, and so I kind of push that. And we did that on no recession. We did that on inflation coming down, and we even did that as exactly as you just said. We said, maybe the contrary story here is the Fed might actually get it right, and so far so good.
It's funny, and you're thinking about the perma bears. I mean, when you have another YouTube channel like we do, I mean, those are the people that really grow their YouTube channels. Like if you just do doom and gloom after doom and gloom after doom and gloom,
Well,
for whatever reason, people love watching that stuff.
Yeah, I mean, I'm on these podcasts very often, and the hosts, the interviewers, often tell me that just for a change of pace, they decided to have me on. There's so much doom and gloom out there, and you'll get the comments, and the comments will say, Yardeni's delusional, and he's looking at he's far fetched. Hey, what about the deficit, and what about this and that, and I'm perfectly aware of all the things that could go wrong. But I've been doing this for a while, and more often than not, we've kind of gotten it right. I've had a couple of issues along the way, but what we're really good at actually is picking market bottoms. We're still working on market tops, and I often point out that if you tell somebody that you have every reason to believe that the market's topping and we're going to have a bear market, I say that's fine, and if it works out, that's even better. But don't forget to tell them when to get back in.
Right. Yep. Two decisions now.
I want to shift and ask you about the Fed now. It seems like we've had this back and forth where we get a bunch of rate cuts priced in, things get a little bit better, we get less rate cuts priced in, and then it kind of reverses back. And right now we're back at the place where we've got a bunch of rate cuts priced in. But I think you said you don't think there'll be as many as there are priced in. Is that right?
Yeah, that's correct. I mean, again, because we weren't looking for a recession in 2022 and 2023, we're totally puzzled. I mean, by 2024, people were starting to acknowledge that, hey, we didn't have a recession, and maybe we're not going to have a recession yet. When you looked at market pricing at the beginning of 2024, the market was pricing in 6 to 7 25 basis point cuts in the federal funds rate. And we were scratching our head and saying, where's that coming from? I mean, people are saying that they're not as fearful about a recession, but that almost suggested that they really thought that the Fed had to cut 6 to 7 times to avoid a recession. And we said the economy just proved its resilience. Why would you possibly be forecasting 6 to 7? But we kind of caved into the consensus and said, all right, we'll give you two or three rate cuts. And so far, there have been absolutely zero rate cuts whatsoever. And there will be one in September 18th. And the big debate is it going to be 20, 25 or 50? We think 25. And we're still kind of skeptical about whether there might be another one before then. After that, I'll concede the point. There probably will be one, but next year, maybe 2 to 4, not another 5 or 6, which is what the market's expecting. And that's largely because of the resilience of the economy, largely because the resilience of the credit markets. We have this credit crisis cycle thesis. It's not really a thesis. We love data, and we like to start with the data before we come to our conclusions. A lot of people start with the conclusion and then find the data to support it. And so we love data, and the data, the history of the credit cycle shows, and the monetary cycle shows that they're kind of intertwined, that when the Fed tightens monetary policy, at some point something breaks. So along the way, you get an inversion of the yield curve. So the inversion of the yield curve predicts not that a recession will happen, what it predicts is that something will break in the financial system. And sure enough, something breaks. And that becomes a credit crunch, and that causes a recession. So inverted yield curves predict a process that leads to a recession. And we were arguing over and over again that we didn't think it was going to work this time. Said the same thing about the leading economic indicators. We didn't think they're going to work this time. And what really made a difference is, we think, is the Fed's experience with playing whack-a-mole, as I mentioned, in the credit markets. They've learned how to create liquidity facilities when something breaks. And sure enough, the whole thesis, the pessimists were right. Monetary policy did cause something to break. It happened last March. The banking system broke. There was 3 banks in California. It happened on a Friday. And by Sunday, the Fed had created a liquidity facility. And they didn't lower interest rates. They just created a liquidity facility, and it worked like a charm. And they were able to maintain their interest rates at a high level. In the past, something would break and they would scramble to lower interest rates to try to keep that from becoming a credit crunch and a recession. But it didn't work. By the time they got around to it, we got a credit crunch and a recession. This time around, the financial crisis so far has not led to a credit crunch. And of course, now with the Fed talking about easing, it's hard to really worry about a recession, because if we're going to be wrong, it'll be that the Fed will avert a recession by lowering interest rates a lot more than we think they have to. But I can live with that.
How do you think about inflation on a more secular level? Like, I think looking back, if I think about globalization, technology, and demographics, those as maybe being the more deflationary trends we had before this whole thing. And now I think about it now, globalization maybe going the other way, but technology with AI may be deflationary. Like, do you think we're in for higher secular inflation going forward than we've had in the past?
No, I think if we're lucky, we'll stabilize around 2%. I think we're about to get there in the next few months. But I think, that's what makes this business so much fun, is you never know exactly what's going to be next. And I won't be surprised if we start worrying about deflation again. I hope the central banks don't respond to it by lowering interest rates to zero and having quantitative easing all over again, because I don't think that's the answer. But I think a lot of the inflation is rooted in global demography. Fertility rates have collapsed below replacement everywhere except Africa and India. And so we have rapidly aging populations almost everywhere, particularly in China because of the one-child policy. And right now, that's a big source of deflation in the global economy, is because, old people don't spend as much as young people. Young people have families buy houses, they have to spend on education, they need cars, they need to get around. Older people don't move as much. The Chinese built all these super duper wonderful fast trains, but old people don't go anywhere. So, who's going to buy the tickets and then, to really make that affordable? And meanwhile, they had a property bubble bigger than anything we've ever seen on Earth, probably bigger than what Japan did, bigger than what we did. And that property bubble has burst. And now the stock market's been going down for several years. So they've got this huge negative wealth effect, which doesn't turn consumers on and wanting to spend money. And then you got all these old folks that have seen that their life savings aren't anywhere near what they hope they would be. They don't have the kind of social safety net the way we do. And so this is a country that was accounting for a lot of global growth, a lot of global demand for commodities, and now that's not happening. So we're seeing copper prices, steel prices, oil prices decline. And energy prices are a huge driver of inflation. If oil prices remain down, that helps to reduce the cost of transporting food, goods, and so on. No, I'm not too worried about inflation. And inflation tends to be spiky. I mean, the one time when it really lasted longer than usual was in the 70s. Other than that, it kind of goes up and kind of goes down, which is another thing that we just got by looking at the data and having faith in the data that, inflation is very symmetrical. The faster it goes up, the faster it comes down. And again, that insight helped us this time around too.
Before we shift to the stock market, I just want to put up one chart from your YouTube channel, which I would highly recommend everybody go subscribe to. You have some great videos you do with you and your analysts. I learned a ton watching them to prepare for this. But this chart is the federal funds rate and financial crises, and it shows the Fed funds rate over time, and it also shows when we've had recessions. And I'm just wondering if you could talk about what the takeaways are from this.
Yeah, well, again, it all goes to the kind of the blending in our way of looking at things at the monetary cycle, at the credit cycle, and the business cycle. They're all clearly interrelated. I think it's just logical. It makes kind of sense. Why wouldn't they be interrelated? I think what happens is economists, for some reason, kind of become tribal about it. And some of them say the monetary cycle is the only thing that matters. And a few say, well, the credit cycle matters. And others say the business cycle has its own logic. It's like, I don't get that. Why don't we just recognize that these things work all in tandem? And what history shows, at least prior to the recent experience, and we're not talking about a lot of history, by the way. I mean, most economists really start their looking at the data and modeling in 1945, some in 1960. And the Fed really only became extremely relevant to the monetary policy cycle since the early 60s. And what that shows is that when there's an inflation problem with or the economy's because the economy is booming, then what happens is the Fed tightens, and as it tightens, the yield curve inverts because bond investors start to believe that we're getting close to a peak in rates because something is going to break as a result of this tightening cycle. And sure enough, something breaks. We get a financial crisis, as the chart shows. And that very quickly leads to a credit crunch. So my contemporaries who've retired, Henry Kaufman was very famous for really focusing on the credit cycle more than anything else. And and he talked a lot about the impact of credit crunches on the economy and the business cycle. So something breaks, you get a financial crisis, and then suddenly it's a credit crunch. The difference between a financial crisis and a credit crunch is in a credit crunch, even good borrowers can't borrow. And a lot of those financial crises happen to occur in the banking system, which then had to kind of throttle back on lending. And so that would then cause a recession. And then when the financial crisis hit, the Fed would panic and start lowering interest rates, and they'd lower in as the credit crunch and the recession occurred. And then they started to raise them once they had some confidence that the economy was what was improving. And again, what's different this time so far? I'm adding so far so that you won't accuse me of jinxing it. But so far, you have to admit it's been different. It doesn't. I'm not telling you it won't be the same up ahead here. But what's been different so far that we can't disagree on is that there has been no credit crunch as a result of the crisis, a financial crisis last year, which turned out to be a non-event. I mean, that could have been it. I mean, that could have been a bank run. It could have been a national bank run. Instead, the Fed provided liquidity to the banks, and the FDIC backed the deposits of those banks. So everybody said, hey, if the government's going to protect us, there's no reason to run out of our deposits. So we didn't have the bank run. But if we did, we'd be looking at a credit crunch. We'd be looking at a recession, and it would have been deja vu all over again. But so far, that's not the case. I'll concede that the pessimistic case made a lot of sense. It made a lot of sense to believe that if the Fed's raising the Fed funds rate by 525 basis points, how could it not cause a recession? And I think certainly with the benefit of hindsight, as again, they tightened from 0 to 5.25%. So some of that tightening was actually normalizing. So I think that's an important thing to factor into one's thinking about the current cycle.
Yeah, now you could argue the pessimistic case made sense for the stock market as well, but that also didn't work out. And
Right.
you've been pretty bullish during this whole thing. And I saw in another interview you talked about, you think we might have like a roaring 2020s type bull market here. So can you just talk a little bit about what you think about the stock market?
Yeah. At the beginning of the decade, and look, I'll admit, I do tend to be an optimist. You have 5 kids. You have to be an optimist these days. Have to be upbeat on the future and your ability to take, at least grow them right. So in the beginning of the decade, I said, there's something rhyming here that, 1920s and 2020s. Could this be a roaring 2020 scenario? And, I wrote my professional autobiography looking back at the 40 years that I've been in the business. I did this in 2018. And one of the points I made in that autobiography is that when I first studied economics, even before I went to graduate school and studied under Tobin, we all kind of studied from the Samuelson textbook on economics for Economics 101. And there's a very depressing thought in that book that says that economics is about the optimal allocation of scarce resources. I mean, that is so depressing. I mean, there's only so much out there, and we all have to kind of figure out how to fight for it. And some economists think the best way to, do it properly is with a market. Other people say, no, the government should allocate the resources. Um, and I said, I don't think that's really what economics is about. I think what economics really is about is having technology solve the problem of scarce resources in a relatively free market. In other words, if there are scarce resources, then their prices are going to go up in a free market. And that gives some entrepreneurs an incentive to say, I think I can come up with a better way to do it, that you're not going to need as much of that resource. And so I came to the conclusion that economics is largely about technological innovations, leading to more progress, leading to more productivity. And so, you'll find that a lot of the pessimists never really talk about, never use the word, the productivity word. They just don't mention it. And we talk about it all the time. And we think that we are in the early stages of a productivity boom. We think it actually started in 2015, but was interrupted by the pandemic. But in 2015, productivity at an annual rate on a 5-year trailing basis was rising 0.5%. It was pathetic. Then right before the pandemic, we almost got to 2%. I mean, think about it, that's a quadrupling of productivity growth, and that goes straight into real GDP. It goes straight into reducing unit labor costs, which is another reason why we thought inflation would come down. And now we're basically around that again at around 2%. And it looks like it's actually doing better than that. It did better than that last year. So if we're right, technology-led productivity gains are kind of like fairy dust. They make everything better. They make real growth better, higher. They make inflation lower. They boost the real wages. Wages rise faster than prices, as they have been, by the way, since 1995. And that got kind of screwed up during the pandemic. But now we're back over the past year and a half where wages are rising faster than prices. It's not just employment that drives purchasing power. It's also, obviously, wages relative to prices, and real wages are, in fact, going up. So, yeah, I think the Roaring 2020s idea is still one that we're promoting. It's our base case. It's not the only thing that can happen. We've been worrying a lot about geopolitical risk, but we've been basically saying the most likely scenario is a Roaring 2020s, which means higher earnings. Earnings have been going up to record highs over the past couple of quarters. During the third quarter, they're going up to another record high. And that's what's really essential to driving a bull market. You have to have something under the air that's inflated into the market with valuation multiples. And we think the earnings are actually there. So I'm using, last year I was using, if memory serves me right, I think we were using 4,600. By the end of last year, we got to 4,600 by the middle of last year. So we said, all right, we're going to stick with it. And in fact, we got to 4,800 by the end of last year. So that's close enough and just kind of ahead of schedule. And sure enough, we're ahead of schedule again this year. We thought that we get to 5,400 by the end of the year, which looked ridiculous at the beginning of the year. Nobody else, maybe one or two guys, Tom Lee maybe was there, but 5,400 looked totally delusional. And we got to 5,400 by the middle of the year again. And so what do we do now? So I said, okay, let's raise it. Let's go to 5,800. And so we're still there. And then next year and a half, 6,500 and probably 8,000. 8,000 by the end of the decade is actually fairly conservative assumption on what earnings will grow at, kind of consistent with history, and what the valuation multiple will be. I do need a multiple of about 20, which again seems delusional, but that's where we are. And a lot of that has to do with the fact that the market is different. It's got the Magnificent Seven, and they really are magnificent. They're not going to go away, and they're going to have high valuation multiples.
So we're talking to you on Tuesday, September 10th, and tonight looks like the first and only debate between Trump and Harris. And do you have any? Does it matter who wins? Does the market react favorably or negatively to either one, or should we really care that much?
I can now kind of get the feeling of what it must have been like to go to a Roman Colosseum. The excitement of seeing this battle, with the swords and the tigers and the lions and everybody just violently attacking each other. Fortunately, the mics aren't going to be live all the time, so hopefully we won't have the interruptions. But yeah, I'm looking forward to the to the games, and I've learned over the years that if you let your politics get in the way of investing or your investment strategizing, you're going to miss some pretty good bull markets because there's always somebody that you're not going to like in the White House. And the fact is, the market learns to live with whoever's there. But I'm rooting for gridlock. I'm rooting for checks and balances to win the election. That whether it's Harris or Trump, that they don't get a Congress that they can just kind of roll over. If we do, in fact, get a sweep of the Democrats or a sweep of Republicans, I may have to radically change my base case to be much more concerned about the deficit, much more concerned about inflation, much more concerned about geopolitics. We're definitely getting a choice here between kind of two quite extremely different sets of policies. But much will depend on the balance of power in Washington, D.C. So I'm hoping for gridlock winning the election. If it does, then I think roaring 2020s will remain intact.
As we kind of get toward the end here, we just wanted to get your take on some of the things that come up often on our podcast regarding different trends in the market that we've seen over the last 10 or 15 years. And the first thing I wanted to ask you about is this value stock underperformance of growth stocks. And do you ever, what are your thoughts on the underperformance of value versus growth?
Well, I'm not a big fan of that dichotomy. As a matter of fact, during this bull market, we've been recommending technology and communications, which is growth. We've been also recommending financials, which tends to be kind of viewed as value. And we've been recommending industrials. I don't know what they are. I mean, you don't usually think of industrials as growth stocks, but they're cyclicals. But they've done well. And our one clunker was energy. But the energy idea was you don't really have to have a lot of energy to overweight energy in your portfolio these days. It's so tiny, and you want to have some just as a shock absorber in the event that things really do go mad in the Middle East or matter in the Middle East. So we're still with that kind of portfolio composition, not kind of doing a growth versus value analysis. We've been arguing that the market would broaden out, and we think with the Fed lowering interest rates, it's already broadening out to the SMID caps. We prefer the S&P 600 to the Russell 2000. Russell 2000 has a lot of companies that have no earnings. The S&P 600 has a lot more smaller companies that have earnings. But we think the market broadens out, and we have this thesis that all companies are technology companies now. You either make technology or you use technology. You have to use the technology tools that are available for every business model in order to stay competitive, to increase productivity. We do on Thursdays, we write a lot about disruptive technologies. So we kind of do research kind of consistent with Kathy Wood's portfolios tend to look like. And there are a lot of very exciting technologies out there where we see the pros and the cons of artificial intelligence. We are watching the development of humanoid robots to work in Elon Musk's factories. There's a lot of technologies that are happening already, are being implemented already, and making a difference. When ChatGPT first came out, I signed up for the $20 model, and I quickly became disillusioned with it because it hallucinated and it wrote very well, but there's a lot of nonsense and misinformation in there. But I've recently been using Copilot on Microsoft, and what's cool about that is it'll answer your questions and give you the references of where it got the information from. Well, I think it's a big challenge to Google because it instead of having to kind of look for the articles, I now look for the conclusion that's got references to the articles.
Yeah, that's the thing with like AI is you could see it being somewhat deflationary, right? In terms of making things more efficient and the savings that you might get. But then again, that kind of plays into margins. So if companies are utilizing this technology to become more efficient,
Right.
then maybe they become more profitable.
Yeah.
And that, plays into sort of the market and valuations and the things
Yeah.
that might drive performance.
Yeah, people for a long time thought that the profit margin for the S&P 500 was just a cyclical variable. It just kind of goes up and down. But, we're starting to see an uptrend in that variable over the past several years. And we think that the profit margin is going to be hitting a new high later this year, early next year of about 14, which would be a record high for the S&P 500. And it could go higher. You use the word deflation to describe the consequences of technology. I would say I would start out by giving it a happier spin by saying it's productivity. And
Mhm.
productivity has deflationary consequences, which are actually very positive. It keeps a lid on pricing, and it justifies workers do get paid more in real terms as a result of better productivity.
I wanted two more questions for you. You've
Sure.
been very generous with your time. We really appreciate it. So just talk about, had a couple questions on forecasting, but just in general, when you think about what makes a successful forecaster, because you have a tough job. I mean, you have to interpret this data. You're putting your thoughts out there, your opinion out there. Someone's holding you accountable. By the way, you hold yourself accountable because you have on your own website, it from the major media outlets going back to '09, your thoughts on the economy and the market. And very few people do that. So I certainly applaud and appreciate the fact that you're doing
Well,
that.
I just have to interject that if I'd been wrong all those years, I don't know that I would have boasted.
Well, that's true.
I'm
But
proud of my record.
no, you should be. And in terms of thinking about how you've been able to be more right than wrong, how would you kind of bottle that up?
I think I've had sort of an interdisciplinary approach to forecasting, involving obviously macroeconomics, but also some appreciation for the fact that macroeconomics is really just the aggregation of what happens at the micro level. Peter Lynch once said, "Look around you and see what you're buying, what your kids are buying, and all that, and maybe that'll give you some ideas for investing." And so I speak to a lot of people, ask them what they're doing. My friends that are retiring, I ask them what they're going to do, and I pick up a lot of the Fed puts out this beige book, so I don't have a beige book, but I talk to a lot of people. I'm fortunate enough to have a gardener, so I ask him, what's going on in his life, what he's buying. Talk to taxi drivers. I talk to clients, not just about the markets, but what they're doing in the spare time. Are they building a new house, or are they going someplace? Um, so I think just kind of being in touch with reality uh, helps a lot. The other thing is I think a lot of economists really start out with a theory, and then look for the data that supports their theory. And that's just not the way we do it. As I said, we love data. We love charts. We kind of look at the charts and then ask ourselves, what's going on behind the charts, in terms of people making decisions, people buying things. And so I think that helps quite a bit.
So we have a standard closing question that we like to ask all of our guests, which is, based on your experience in the markets, if you could teach one lesson to your average investor, what would that be?
Oh, I mean, that's a layup. For stock investors, buy dividend yielding stocks, put them away. Obviously good companies are better than that. Dividend growers are better than that. And you're going to get a lot of sleep. I think to make money in the markets by picking tops is tricky, because then you've got to pick the bottom. Fortunately for me, that's one of the things I'm supposed to do, and so it gives me something to do. If I just told people all the time, just buy, don't, I got nothing to tell you but buy stocks. That's not, people want to hear, well, yeah, but are we about to see like a 50% implosion, and nobody wants to kind of live through that. But I think I'm in the Warren Buffett camp, viewing stocks as long run investors. Having just said that, I see Warren Buffett's got more cash in his portfolio than he's had in a very long time. So that kind of has me a little bit concerned. So I do kind of pay attention to that. On a short-term basis, I think, being somewhat skeptical about the consensus, when everybody's so convinced that things are going to go wrong, ask yourself, try to think about what might go right. And again, look around you, what do you see? Do you see doom and gloom, or do you see some optimistic things going on out there?
It's been great, Ed. Thank you very much. We really appreciate it.
Very welcome. Thank you. I enjoyed it.
This is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant, and follow me on Twitter at JJCarbonell. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.